The United States is working to rebuild its shipbuilding industry and challenge China's dominance in the global ship construction market. In a related move, Japanese shipping company Mitsui O.S.K. Lines has announced a temporary pause on ordering liquefied natural gas carriers from Chinese shipyards. On May 23rd, the Nikkei reported that Mitsui's president and CEO, Takeshi Hashimoto, said the company will adopt a wait-and-see approach towards new contracts with Chinese shipyards. Liquefied natural gas, or LNG carriers, play a critical role in the global energy supply chain, transporting natural gas from producing countries to consuming countries. As of the end of March, Mitsui owned 107 LNG carriers, the highest number worldwide. Following closely is another major Japanese shipping company, Nippon Yusen. With 89 LNG carriers, Mitsui plans to expand its LNG fleet to 140 vessels by fiscal year 2028 to meet growing demand for LNG transportation. LNG carriers require advanced technology and specialized equipment, such as storage tanks for high-pressured gas. Due to labor shortages and other factors, Japanese shipyards have not received any LNG carrier orders in the past decade. Mitsui previously bought most of its ships from Chinese yards. Under the current U.S.-China trade tensions, Mitsui is pausing orders from China and shifting to South Korean shipbuilders. Mitsui's decision reflects real pressures faced by the shipping industry. The company believes that the U.S.-China trade conflict and an increase in Chinese-built ships would negatively affect its operations. In April, the U.S. Trade Representative announced that starting October 14, 2025, new port fees would be imposed on ships built or registered in China, regardless of the operator's nationality. Each qualifying ship will be charged $50 per net ton every time it enters a U.S. port for the first time on a voyage, with an annual increase of $30 over the next 3 years. This means that fees will gradually rise from $18 per ton or $120 per container over 3 years. The fee is charged per voyage, not per port call, with a maximum of 5 charges per ship per year. These port fees are expected to have a significant impact on the world's major shipping companies, both economically and structurally. Regarding LNG carriers, the U.S. also requires that starting April 17, 2028, at least 1% of all U.S. LNG export vessels must be transported using American-made ships. Previously, a large portion of U.S. imports was transported by Chinese-built ships. Chinese shipyards offer lower prices and currently hold over half of the global new ship orders. The U.S. increase in port fees for Chinese-built ships aims to revive its shipbuilding industry and reduce China's strong hold on the global market. At its peak during World War II in 1944, the U.S. shipbuilding industry was considered the strongest worldwide, with 1.4 million jobs. At the war's end, the U.S. operated over 100 shipyards, supporting 57% of U.S. trade transportation. The majority of global trade was carried by American-built ships. Today, China leads as the largest shipbuilding nation in the world, with a shipbuilding capacity 232 times greater than that of the U.S. in terms of commercial shipping tonnage. On March 11th, the Center for Strategic and International Studies, CSIS, released a report analyzing China's expanding shipbuilding capabilities. It found that in 2024, China State Shipbuilding Corporation built more commercial ship gross tonnage than the total output of the U.S. shipbuilding industry after World War II. Among the 10 commercial oil tankers currently used by the U.S. Department of Defense for fuel transport, 3 were built in China. Of the 12 newest dry cargo ships transporting goods for the Defense Department, 7 were also built in China. On March 26, U.S. military expert Mike Friedenberg wrote that this situation means the U.S. Navy and the broader U.S. economy are highly dependent on foreign-built ships, including those from China. He described this as a risky position. Assistant researcher Tsai Cheng-han from Taiwan's Institute for National Defense and Security Research highlighted that the CSIS report categorizes Chinese shipbuilding into 4 risk levels: very high, high, medium, and low, ranging from shipyards directly involved in military construction to those seemingly focused only on commercial shipbuilding. From a technical perspective, regardless of risk level, China's government maintains full control over the shipbuilding industry, allowing it to acquire critical technologies from foreign companies. For example, China obtained LNG carrier design, construction, and engineering technology from Gas Transport and Technogaz SA, a French group. Any shipbuilding technology could potentially be used by the Chinese military. This capability not only expands China's naval strength, but also provides a competitive edge in the global supply chain. Meanwhile, foreign orders have fueled the growth of China's shipbuilding industry. This trend impacts the global shipping market and carries significant implications for international political and economic dynamics, posing supply chain security challenges for the U.S. and its allies. In shipbuilding, the capabilities of the U.S. and its allies, South Korea and Japan, are increasingly marginalized by China's rise. The report emphasizes that democratic countries such as Japan, Germany, and France are becoming more reliant on Chinese shipyards. From the perspective of global supply chain competition, efforts by democratic nations to pursue supply chain decoupling from China face considerable challenges. Initiatives like the Transatlantic Alliance Plan promoted by former U.S. Treasury Secretary Janet Yellen to deepen supply chain cooperation may prove difficult to realize. In response to this situation, the U.S. introduced the Ships for America Act in December 2024, aiming to revitalize the domestic shipbuilding industry to meet China's challenge and prepare for future competition. In March this year, President Donald Trump announced the creation of a new Office of Shipbuilding. Speaking before Congress on March 4th, Trump said, "To boost our defense industrial base, we are also going to resurrect the American shipbuilding industry, including commercial shipbuilding and military shipbuilding." He added that tax incentives will support domestic shipbuilding development. The newly established Office of Shipbuilding will coordinate efforts to assist the struggling U.S. shipbuilding sector. Mike Friedenberg noted that the U.S. Office of Shipbuilding addresses a national security risk and seeks to restore the U.S.'s maritime power. He said these measures are not optional, but necessary. Commentator Xu Zhen said some orders will inevitably shift, but the scale will likely be limited due to four major constraints. First is the cost of switching orders. Once contracts are signed and deposits paid, transfers are unlikely. More importantly, South Korea and Japan, the other major shipbuilding nations outside China, have their yards fully booked in recent years, leaving little capacity to take on new orders. New shipyards or expanded capacity requires time to develop. Therefore, in the short term, China's dominance in the global shipbuilding industry is unlikely to change. Data shows that despite U.S. countermeasures, several Chinese shipyards still secured major orders in April. According to Clarkson's research data released May 9th, Chinese shipbuilders won 51 new ship orders totaling 2.5 million compensated gross tons in April, capturing 69% of the global market. For example, Italy's shipping giant Grimaldi Group signed a $1.3 billion contract with China Merchants Industry Weihai Jinling Shipyard for 9 methanol-fueled roll-on roll-off passenger ships. Hongli Heavy Industry received orders from Mediterranean Shipping Company for 6 22,000 TEU dual-fuel LNG-powered container ships. COSCO Shipping Company subsidiary Orient Overseas Container Line ordered 14 methanol dual-fueled container ships, each with a capacity of 18,500 TEU. These vessels are being built by Nantong COSCO Kawasaki and Dalian COSCO Kawasaki shipyards under a contract valued at $3.1 billion. Waigao Chao Shipbuilding also secured a contract from Seaspan Corporation to build 6 container ships with a capacity of 11,400 TEU each. This means shifting this landscape will be difficult in the short term, but over the medium to long term, the situation may evolve differently. Xu Zhen said, "The key factor is whether countries like the U.S., Japan, South Korea, and India can quickly expand their shipbuilding capacity to absorb orders shifting away from China. These countries have already begun planning. First, the U.S., Japan, and South Korea have many old shipyards that can be revitalized with fresh investment. Of the 62 shipyards in these 3 countries, 32 remain operational, 12 in the U.S., 10 in Japan, and 10 in South Korea. The other 30 are idle, closed, or bankrupt. These assets can be restarted instead of building from scratch. For example, the U.S. has significant potential in shipbuilding, maintenance, and repair, including aging but still viable capital assets, skilled labor, mid-level management, and engineering talent. With proper funding, these countries could increase current capacity by 30 to 50%. Second, cooperation between South Korea and the U.S. shows promise. In March 2024, former U.S. Navy Secretary Carlos Del Toro visited South Korea, promoting HD Hyundai and Hanwha to gain certification to maintain U.S. Navy vessels. The U.S. also invited South Korean shipbuilders to set up factories on American soil to support new warship construction. After President Trump's election in November 2024, his call with former South Korean President Yoon Suk-yeol emphasized the urgency of U.S.-Korea shipbuilding cooperation. In 2024, Hanwha Marine secured U.S. Navy maintenance contracts at its Korean shipyards, addressing urgent U.S. naval repair needs. It also invested $100 million to acquire a Philadelphia shipyard, helping solve U.S. domestic shipbuilding issues. Hanwha acquired shares in U.S. LNG developer NextDecade to expand its U.S. market influence. HD Hyundai, South Korea's largest shipbuilding group, told a Hudson Institute seminar in March that it sees buying U.S. shipyards outright or partnering with local yards as viable options. Its HD Hyundai Vietnam shipyard has received orders for over 200 vessels and is becoming a strategic asset in South Korea's effort to compete with China. By upgrading technology to Korean standards and lowering labor costs to Chinese levels, it holds a unique edge in the global new ship order competition. Third, the U.S. has a huge market for new ships. Congressional budget documents reveal plans to expand the Navy fleet from 295 ships last year to 390 by 2054. Retiring old vessels will make way for 364 new warships. Estimates put the cost at $1.8 trillion US. If most orders are done domestically or go to allies like Japan and South Korea, it would open an unprecedented new market. The Ships for America Act, proposed in late 2024, sets a national goal to grow the U.S.-flagged commercial fleet from about 80 ships to 250 over 10 years. It also requires 15% of U.S. liquefied natural gas exports and 10% of crude oil exports to be transported by U.S.-built ships. Clarkson Research projects the U.S. will need 234 LNG carriers by 2030. With orders expected by 2027. Fourth, India is poised to emerge as a rising player. India ranks as the world's 16th largest maritime nation. Seaborne trade accounts for 95% of India's trade volume and 70% of its trade value. The Indian government plans to expand its own fleet to 1,000 ships within 10 years, with significant new shipbuilding. India aims to join the top 10 shipbuilding nations by 2030 and reach the global top 5 by 2047. To achieve this, the government has proposed policies including 10-year subsidies and establishing 3 shipbuilding clusters. India has sought help from South Korean shipyards. A 2024 Indian delegation had productive talks with South Korean shipyard leaders, and in 2025, both HD Hyundai Heavy Industries and Hanwha Ocean visited India for site assessments. Xu Jin believes that if the U.S., Japan, South Korea, and India take appropriate measures, the global shipbuilding landscape could be reshaped in the medium to long term, dealing a serious blow to China's shipbuilding industry. Since the first Trump administration, the U.S. has abandoned the hope Chinese Communist Party would peacefully and democratically transform. It recognizes the CCP regime's oppressive domestic policies and aggressive external expansion, leading to strong countermeasures. In addition to the U.S. shipbuilding resurgence, this channel has reported multiple times on U.S. tariffs and chip sanctions against China. Recently, the U.S. and European countries have united to issue warnings to the CCP. On May 23rd, the U.S. House Select Committee on the CCP and the Inter-Parliamentary Alliance on China held a roundtable meeting and issued a joint statement condemning the CCP's attempts to undermine the global order. The statement stressed that domestic countries must unite against authoritarianism and clearly expressed support for Taiwan as a beacon of democracy and an important partner of the U.S. The IPAC delegation included members from the UK, Slovakia, Germany, and the Netherlands. The meeting was co-chaired by Select Committee Chairman John Molinar and Congressman Raja Krishnamurthy, both IPAC members. Other U.S. lawmakers in attendance included Neil Dunn, Dusty Johnson, and Dan Newhouse. Members of the U.S. Congressional Executive Commission on China also participated. Molinar said in a statement, "The Chinese Communist Party is working overtime to divide democracies and exploit the gaps between us." He said this underscores the importance of that day's IPAC meeting. He added that through transatlantic unity, democratic nations can defend their systems and values, ensuring that the 21st century international order is led by free nations rather than authoritarian regimes. Dutch MP and IPAC co-chair Jan Paternoot said, "Authoritarian aggression thrives when democracies are divided. This joint commitment shows that transatlantic lawmakers are united in defending freedom and resisting CCP influence." Both the U.S. and Europe are pushing back against the CCP, and over time, China's unchecked global dominance will be challenged.